Hello, and welcome to the video for PepsiCo's 2017 Annual Report, Liability Disclosures and Times Interest Earn Ratio. So we can learn more from an actual annual report or some of the details that might be a little bit more in-depth and realistic than what you learn in your textbook. So we've already seen PepsiCo's 2017 balance sheet, and I excerpt here the liabilities. We've already talked about current liabilities, $20.5 billion. About $5.5 billion is short-term debt obligations, interest-bearing. The $15 billion is accounts payable and other current liabilities. How much is accounts payable? How much is other current liabilities? We will see by looking through the footnotes. Long-term debt obligations, for which the principal amount or the face value owed is owed in more than 1 year or operating cycle, are $33.8 billion. What I think the trickiest thing here is other liabilities. I had a hunt for these, and I think there should have been a note for them, just like there was a note for other long-term assets, but there wasn't. Other long-term liabilities, first of all, they went up a great deal, $11.3 billion versus $6.7 billion. And what's included? Well, pension and retiree medical obligations that aren't yet funded by pension assets. Companies keep a separate entity for funding pension assets, and they keep track of pension liabilities. If the pension assets aren't as big as their present value of future pension liabilities, the shortfall is a liability. That is $3.3 billion here. Another thing is there's a one-time tax adjustment for tax on undistributed international earnings due to the 2017 Tax Cut and Job Act. Used to be companies with lots of subsidiaries abroad, like PepsiCo or Apple, could avoid paying U.S. taxes by keeping the earnings within the subsidiary abroad. They would only pay taxes when they take the money back repatriated to the United States. Well, the Tax Cut and Job Act changed that, having a one-time tax on undistributed international earnings, but in the future we'll have lower tax rates for corporations. Deferred income tax is a tricky concept. On financial statements, we calculate income tax expense using financial statement income. However, for tax returns, there's another set of accounting principles for which we calculate income tax paid. Sometimes, and most often, companies use a method for their income taxes that lets them pay fewer taxes in the short run, but oftentimes these reverse and they pay more in the long run. Think about accelerated depreciation. You get a bigger tax deduction today, you might have an accelerated depreciation method like MACRS on your tax return, which you'll pay less income today because you'll have a bigger deduction, but eventually under MACRS in the later years, you'll have a lower tax deduction for depreciation in your tax return than financial reporting. So these are timing differences between the way you recognize income and revenue and expense on your tax return versus your financial statements. So this total liabilities of about $68.8 billion, how do we know to recognize it or when to recognize it? Well, when should you recognize something about which you're not quite sure? Contingencies and commitments. Remember that liabilities are obligations due to present transactions. And they say, what would you do if someone's suing you? Would you recognize that as a liability? Well, PepsiCo explains we're subject to various claims and contingencies based on lawsuits, certain taxes and environmental matters, environmental remediation obligations, as well as commitments under contracts and commercial obligations. They recognize these liabilities for contingent events in the future and commitment when a loss is probable and when you can estimate it. So it's a lawsuit that you're pretty sure you lost and you're pretty sure about the amount of damage. It's an environmental remediation liability that you're pretty sure that they're going to make you clean up and you have a good idea how much it costs. They do disclose more information about this in the notes. There's always going to be, for most companies, a footnote on debt obligations, and this breaks up the short-term and the long-term interest-bearing debt. Short-term debt obligations of $5.5 billion in current liabilities include current maturities of long-term debt, $4 billion, commercial paper, which is initially a short-term borrowing for a few months, and other borrowings. Long-term debt obligations include the portion of long-term notes whose face value is not due to be repaid in the current operating cycle. Current maturities of what was originally long-term debt, $4 billion, go right up to short-term debt obligations. And after deducting, so here's all our debt obligations which were originally long-term, take out the principal part of that which matures in 1 year or one operating cycle, whichever is longer, and we get the $33.8 billion of debt obligations in the balance sheet. Your textbook talks about a lot of these notes payable or bonds payable are not issued at their face value, but either below or above. Well, it looks like on average, PepsiCo's notes and bonds payable were issued a little bit below their face value. So the amount you see here isn't the total amount due, but net of unamortized net discounts of $155 million in 2017 and $142 million in 2016. Interest rates for these obligations, presented in parentheses on the left-hand column, reflect weighted average rates for these debt at year end. So to learn more about footnotes, as I told you before, Note 13 provides supplemental financial information that shows details for accounts payable and other current liabilities of $15 billion. What surprised me is that only $6 billion of these are, or $6.7 billion are accounts payable out of this $15 billion. There are other obligations like accrued marketplace spending. That means what they owe for advertisers, for people that are printing materials for them. So accrued marketplace spending is big in a brand name product like Coke or like Pepsico or Frito-Lay. So that's one of the reasons why it's relatively big here, about $2.4 billion. Other things we could look at: accrued compensation and benefits. I think you guys have seen this as wages and salaries payable, dividends payable to stockholders, and other. Let's look at things that are in the management discussion and analysis. So the management discussion and analysis, often called MD&A, precedes the financial statements and tells you a little bit about when you have upcoming commitments. Some of them are recognized on the balance sheet because they are future sacrifices of economic benefits based on present obligations, like you borrowed the money. As long as you continue to borrow the money, you will have to repay the principal, but you don't pay the interest until it's due. So in the future, if you keep holding, if you decide to keep borrowing and not repay these notes payable, this will be your future interest, but we don't recognize it until we incur it. Operating leases. If you have shorter term leases that don't meet the definition of a capital lease, they may not be on your balance sheet yet. There is going to be a change in accounting principles relatively soon that will put these on the balance sheet. And purchasing and marketing commitments. You might have decided that you're going to buy a new machine, but if the machine's not yet delivered, you wouldn't recognize it until the other party fulfills their part of the contract. That's an executory contract. So only the part that's already been fulfilled would you recognize the liability. But this gives you a good idea of commitments that you've intended to make, some of which are already on the balance sheet, some of which are not. This is in the liquidity and capital resources section of the MD&A. Okay, how can we use financial statement information to analyze these liabilities? Times interest earned measures solvency. Can you stay around for the long term and repay your long-term debt, not just your short-term debt? What is your capital structure like? This uses income statement figures. Times interest earned is net income. We use net income available to common shares. Add back interest expense. Interest expense can be tricky. For Pepsico, it wasn't bad, but some companies, especially if they don't have a whole lot of it, they might just put one line, interest expense net of interest income. So you might have to look in the footnotes or substitute cash interest paid from supplemental information in the statement of cash flows. Pepsico made it easy. If not, you might have to look elsewhere for it. Income tax expense, which usually in most financial statements I see described as provision for income taxes, is $4.7 billion. If we add these three up, divide them by interest expense, we get 9.3 times interest earned in 2017. What that means that PepsiCo in 2017 has pre-tax, pre-interest income 9.3 times as large as its interest expense. In 2016, it had 7.34 times pre-tax, pre-interest income compared to interest expense, or 7.34 times interest earned. Thus, PepsiCo is more solvent in 2017 than in 2016 using this ratio. In both years, however, the ratio indicates more than enough interest coverage to satisfy most lenders of its solvency. This chapter also reviewed ratios from Chapter 2, which I will put here for your information, but not spend a lot of time. Another solvency ratio is debt to assets, total liabilities to total assets. And we saw that PepsiCo was less solvent because it had more debt financing its assets in 2017. We also saw a liquidity ratio, which we learned in Chapter 2, current ratio, which is whether you can pay your current obligations as they come due and meet unexpected needs for cash, taking current assets and current liabilities. We said that PepsiCo was a little more liquid in 2017. Please feel free to use this presentation or the printout of it that I will put in Moodle before looking at your own company's annual reports for the weekly discussion board. Good luck and get started, Jaspers.